Hello and welcome to Virtual Investor Conferences. My name is Eric May, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Community First Bancorporation. Before we introduce our speakers, please note, submit your questions in the question box to the left of the slides. All of today's presentations will be recorded and available for 24/7 replay. At this point, I am very pleased to welcome Jennifer Champagne, EVP and CFO, and Richard Burleson, President and CEO of Community First Bancorporation, which trades on the OTCQX specs market under the symbol CFOK. Welcome, Jennifer and Richard.
Thank you. On behalf of Community First Bank, its board of directors and its executive management team, it's an honor and a privilege to be with you today. If you look us up, you'll see that we're based out of Walhalla, South Carolina. I'm sure that many of you have no idea where Walhalla, South Carolina is. But we're about 45 minutes due west of Greenville, South Carolina. So we're an upstate bank. We were founded back in the 90s. To get a little bit more specific on our location, nobody knows where Seneca or Walhalla or any of this area is, I'm sure. But we do have a little college right down the road that many of you, I'm sure, have heard of. It's called Clemson. They play a little football there. So that's kind of who we are and what we're located nearby. So when you think of CFOK, you can think about the Tigers and the way that they tend to dominate the college football scene here in the Southeast. We won't get into that for you Georgia fans. Joining me today is going to be Jennifer Champagne. She's Executive Vice President and Chief Financial Officer. And we'll just hop into the slides here, if that's okay with everybody. And as we get going into this, if anybody has any questions, then by all means, put them in the chat and we'll answer them as we go. First slide up is the management and the board of directors. Here again, I'm president and CEO. I've been with the bank. I joined the bank in 2013 as a consultant. I come on board at the time that the bank was under its first consent order for safety and soundness. We got that cleaned up, had a management change with me coming on board as president and CEO in 2015. At that time, we were under dual consent order, one for safety and soundness, one for information technology, as well as all the issues with MOUs at the Fed. So it's been a whirlwind. Jennifer joined us in November of 2017 as our Chief Financial Officer. Done a great job for us, really helped us move things along. And also another gentleman on the executive management team, Stuart Hester, Chief Banking Officer. He is responsible for all business production functions in the bank. He was unable to join us today. Also listed here is my board of directors. We've got 9 directors. 5 have been here since the beginning. But when tough times hit, we put some new blood on the board, and we've got 4 younger folks that do an outstanding job of moving things along. So I want to address that. Next slide is our corporate overview. Here again, we trade as CFOK. Chairman of the board is Gary Thrift. That'll give you some information on total assets and some of the metrics. As of this morning, our total assets was right at $670 million in total. When I took over the bank in 2015, we were $349 million in assets, about $150 million in loans. Today, we've got about $500 million in loans. You can see where our ROA is. We've been lagging for a couple years, and that's understandably because, quite honestly, it's when you're under a consent order, much less 2 consent orders, it's not that you can come in and start doing crazy loans and growing. You have to get out of the mess before you can actually start growing the bank. But we've done a good job on that. When I took over the bank, we were actually 7 offices. Today, we are a total of 12 offices located in the upstate of South Carolina, Tennessee, and North Carolina. Trading overview, you can see where we are. We are definitely trading below book. It would be, in my opinion, it's a great opportunity to get in on a good stock with a great management team and a management team that's ultra conservative. We do things the right way, understanding that I'm a credit guy. We're pretty conservative on our credit. And honestly, when we get into the loan metrics, I hope I have lots of questions, because I will tell you, I will put this credit portfolio up against any bank in the nation. And we can get into some more details on that as we get into the presentation. The turnaround story, you can see 2012, the bank was placed under consent order. I won't waste a lot of your time here, but you can see we've made lots of progress. We've had systems conversions. We've added a lot of technology. We've added an SBA group that's doing quite well. We did try a mortgage company for a while. Thank the Lord we got out of that mess last year. We'll never do that again. We won't spend a lot of time on that, but that was a challenge. But all in all, it's been a good ride, and we're definitely going in the right direction. The board is very happy with where we are, and ultimately we want to continue to grow and expand here in the upstate and in the Carolinas as a whole. Next slide coming up is active markets. You can see Seneca, South Carolina. We have 4 offices here in what is termed as Oconee County. We are definitely top in the market there. Greenville, we've been in Greenville for about 3.5 years now. There's a lot of banks in that market. We're starting to build some good traction there. The challenge was as we got into the market right before the pandemic. The pandemic hit, and then it was a little bit of a challenge. Earlier this year, we went into Johnson City, Tennessee, and that resulted from a acquisition we had of a little bank in East Tennessee in Elizabethton called Security Federal. They had 2 offices, and we closed one of those offices, went to a higher production opportunity MSA in Johnson City. We opened that office in January, and we're starting to really get some good traction there. Our number one, without a doubt, office or production area is Charlotte, North Carolina. Our loan volume there has been outstanding. The opportunities for loans in that market is outstanding. And I say this to kind of preface that we say that we're in Charlanta. And that's the difference between Charlotte and Atlanta. And that's one of the largest mega regions in the United States. And it's very dynamic. We love where we are. Core values moving forward. We absolutely believe in superior customer service. We are epitome of a community bank. When our customers walk in the door, we address them by name. We treat them in the way that we would want to be treated. And I know that everybody on this call will tell you the same thing, but we take it to a different level. We pride ourselves on what we do, and we're trying to move the needle in every which way that we can to continue to bring forth community banking values. As noted, we have excellent asset quality. Here again, I will put this loan portfolio against anybody in the nation, bar none, and we'll outperform even the biggest and the best. Improved earnings. We're continuing to improve our earnings. We are focusing, like every bank in America, on the low cost of funds and deposits, and Jennifer will talk more about that in a moment. But we're making some strides there. We're trying to absolutely increase all of our shareholder values and tangible book value. And ultimately in the Carolinas, honestly, we're building a little bit of scarcity value. When I got into banking, I started out in North Carolina. There was 140 banks. Today there's 38. In the state of South Carolina, there was well over 100, and there's less than 40 today. So we're tending to get a little bit of a scarcity value here in the Carolinas, which, in my opinion, helps with the scarcity value. We continue to leverage up and introduce new products. Prior to joining the bank, I had a career in finance, consumer finance, and mortgage. So I brought those aspects over when I come to the bank. And we do, when we get into loan numbers, you'll see that we have a lot of loans showing in our consumer bucket, and that is a sales finance division that I started in 2016 that is out of this world. It's absolutely amazing. When I say sales finance, I don't mean auto finance. I don't want to do autos. We do marine and RV, and when you look at that portfolio, it is really an outstanding portfolio. We can get into the mix on that. Here again, next slide is the loan portfolio. Over there on the right, on the bottom, you can see consumer and other. You can see the percentage of our portfolio in that. We also have 22% and 1 to 4 family, and then a little bit of everything else. When I come to the bank in 2015, I was basically the only commercial lender that the bank had. Now in the markets we've went into, we've added a lot of talent, and we're doing a lot of different CRE and different types of lending. One thing that I wish we could be a little bit more heavy in would be C&I. I think that's needed, especially as we go into the next couple of years. But you can see a snapshot of the loan portfolio. Sales finance, the business of sales finance. Here again, we started this. We started in 2015, didn't get it up and running until 16. But you can see some of the numbers there. My past due ratio, I can literally count the number of repossessions, knock on wood, on my hands and my feet over that time frame. We only buy the creme de la creme paper. And the way this works is, honestly, I can sit in the queue and take the queue and do the underwriting, let my guys be off on Saturday if I need to. And we turn around where we earn business. We compete against the big boys in this. Is where we earn business is we give the best service and the best turn times. Using mobile phone, you can do a deal and respond to a deal in about 3 minutes. So that's where we're really starting to make strides and do very well. Here again, I'm happy to get into this because everybody that comes to look at our bank has lots of questions about sales finance. But our premiums, our rates, and our past dues all speak for themselves. I'm going to turn it over to Jennifer Champagne as we get into the deposit products and the financials.
Good morning, everyone. Thank you for joining us. On the deposit profile here, you can see our deposit composition. Over the past several years since I came here, we've really tried to focus on non-time deposits. The bank had a history in the past of being nicknamed the CD bank. And we really just felt like that's really difficult way to build relationships because you don't see your customers as often. You are utilizing a more rate sensitive type of product. So we started moving towards more of a non-maturity deposit type profile. And you can see that reflected there on your screen in terms of total deposits. Now, times are changing a little bit. The market is an extremely rate sensitive market right now. And so it's becoming more difficult. Larger banks are definitely playing in the community bank space where it comes to deposits. And it's becoming a little bit more competitive and a little bit more rate focused. But one of the things that we've got in our toolbox is that we do tend to know our customers, to have deep relationships with our customers, and we are offering ways for them to extend their FDIC insurance coverage through the IntraFi network and addressing the things that they're concerned about in their business and making sure that our products are meeting their needs. We're looking right now at making a next step improvement in our internet banking and our digital onboarding products. We do have those. We partner with FIS for our core, but there's some ancillary systems that may or may not stay with that core as we evaluate and try to bring our products and keep our products at the forefront of what customers and their financial people are expecting. So we are incenting our lenders right now more heavily on bringing in deposit relationships, specifically obviously non-time deposits when you're talking about commercial deposits, but also emphasizing that that they too can have extended insurance coverage if that's something that they're concerned about. So another thing I'll mention is that we do monitor our uninsured deposits. At the end of the first quarter, our uninsured deposits were estimated at around 13% of total deposits. We do monitor that, and I would say that more than likely since March, that number would have declined just a bit, because that was about the time when some of our customers were becoming more interested in having the extended FDIC insurance coverage. That's a number that we update quarterly, and we keep an eye on to make sure that we understand how much uninsured deposits that we actually do have. So next slide, Richard. Okay, so on this slide, you can see our net interest margin. We do have, at the end of the first quarter in 2023, we were at a 371 net interest margin. We are somewhat, like most community banks, dependent on our net interest margin. That is the bread and butter of a community bank. During 2022, we had a little bit of an anomaly in our net interest margin, in that we were able to hold interest rates low when the Federal Reserve first began to move interest rates. And so we actually had an improvement in our margin throughout, and had our deposit costs declining during the first few quarters of 2022. Of course, as the Federal Reserve piled more and more interest rate increases and at larger steps in, then of course our markets became much more interest rate sensitive. So we had expansion of our NIM in 2022. We had an additional bit of a expansion in our NIM in 2023, but dependent on the Federal Reserve's pace of change, that could, and also with the increasing sensitivity of interest income to how depositors are becoming more sensitive to it, you could have some pressure on the margin going forward. We're doing our best to battle that by bringing in less interest sensitive deposits through the commercial non-time deposit side. But you can see our NIM there. Obviously, we're targeting a 4% plus NIM, but that's a little bit harder to do in this market right now. Customers are extremely interest sensitive at this time. So this slide speaks to our revenue and expenses, especially the non-interest income and the non-interest expense. In 2022, we mentioned that we sold our mortgage subsidiary. We do continue to offer mortgages through the bank. We also do sell and service for Freddie Mac, and we are working with our customers anytime they need a mortgage product. And that was something that we acquired with the small bank that we acquired in Tennessee. They were already servicing Freddie Mac and had all of the policies, procedures, reporting, all of those things were already in place with that company. So we expanded that as we moved forward, of course, before some of the rate escalation. But the reason that we decided to sell C-Trust Mortgage is that business had a very national focused CEO in that segment of the company, in that subsidiary. Our president, he was really looking to go national with his platform. And we just felt like that that size of a mortgage company and the volatility that it brought was more than we wanted to work with. And that really became something that was very noticeable, I think, in the year of 2022, where, mortgage rates were really changing quickly, and the value of those mortgage assets, we were hedging, but it just really increased a lot of volatility into a community bank's income statement for something that was expanding very far outside of our core geographic area. Obviously, we have 12 branches. They're in North Carolina, South Carolina, and Tennessee. The mortgage expansion all the way across the country was really a bit outside of our footprint and a bit outside of the core business. So we sold that. That sale was effective in May of 2022. So in the second quarter and then later on in 2022, you would see us back to the core business of banking that we're very very familiar with and very comfortable with. The non-interest income in the bank is something that we are focused on. We know that is something that as a percentage of total revenues, we need to increase, and we're working on that very hard. One of the things that we've done this year with our SBA platform is we've brought in some very experienced individuals in that area. They have a collective just immense amount of experience. And we've brought in a new platform that allows us to do a much, especially your smaller SBA loans, in a really more efficient manner. And so that's going to help us as we go forward. We've just gotten that platform fully in place and fully operational. We have 3 lenders in that group, and our pipeline is doing quite well. Those are, they take time. And so we expect to see a little bit more impact from our SBA line later in 2023, now that system is up and running and we've got a number of loans in the pipeline. Our non-interest expense, as Richard mentioned, has been a little bit higher than we'd like. When you come out of when we came out of the agreements with the regulators that we had that began in 2015, one of the things that they do is they layer on internal controls, reporting, somewhat duplicative audit services, and check the audit and then audit the audit and kind of that kind of thing. So we've had to do a little bit more with those kinds of things. But over time, when they realize that our systems are functioning properly and working really, really well, and that the internal control systems and the compliance systems are working properly, then they allow some of that duplication to fall off. And we've also done a good job with linking up. We have some systems where our say, for instance, loan origination can flow directly into our core from the origination side. There's some things like that we've done with efficiencies. And so we have seen over time that efficiency ratio start to actually move. And if you look at, 2018, 19, 20, you can really see that efficiency ratio is moving in the right direction. This is our capital situation. For leverage capital, we're over 10%. We do exclude AOCI in our bank leverage ratio in our regulatory reporting. Like everybody else, we have securities that were purchased, and so we have some unrealized losses in our securities portfolio. But we have the capability to borrow against that portfolio, and we feel like we will be able to retain the liquidity that we need to without actually realizing those and allowing those to mature off. So we feel like we'll be able to do that. The average life for the securities portfolio is 8.6 years. We would love for that to be just a little bit shorter, but it is where it is. And so we're borrowing against it if we need to. Okay. All right, Richard, you want to speak to this?
All right. Yes, this talks about the asset quality trends. That kind of speaks for itself. I'm going to hop back to some of the questions, if that's okay. One question was talking about how we measure asset quality. Like I said, we're very conservative here, and we look at asset quality on a whole different spectrum. As a former credit consultant, we hold ourselves to a much higher standard on credit than most community banks our size. Example, excuse me. If you look at cash flow, most community banks have a minimum cash flow coverage of 125. We're at 140. Most community banks look at loan to values in the 80, 85, and 90%. We're not that way. We're more conservative. We want to be well below what the standards are. And in doing that, we pick up higher credit quality customers. But how do we track our credits? We have internal loan review on a quarterly basis of loans in excess of $1 million. We have third-party loan review that comes in twice a year and does everything in this portfolio greater than $250,000. We look at this portfolio, we scrub this portfolio continuously. We are part of CECL, so we're looking at it at levels that most community banks our size don't even think about. So when we talk about credit monitoring, that's how we look at it. There's been a couple questions regarding the mortgage company, and I think Jennifer hit that pretty well. Honestly, it was kind of a case of the tail wagging the dog. From the volatility, the bank could have really good earnings one month, the mortgage company would lose money, and then we would be behind the eight ball. So that's the reason that we got out of that, and I'm glad that we got out of it in the nick of time before rates went grossly high. Jennifer, would you like to handle some of these questions, please? I'm sorry.
I will. I think that there's a question here about the buyback program and any plans to pay a dividend. The bank, in the history of the bank used to pay a lot of stock dividends, and we have not done that. We've not paid stock dividends since 2012. I think that was an effort to, obviously, while the bank was growing, maybe try and increase the liquidity of the stock. It really wasn't traded much at all in that time period. We did pay last year a dividend. We paid a dividend in the first quarter last year. We would really love to pay a regular dividend. But at this time, we're really looking hard at the possibility of going into a recession with the rates and Fed's sort of target on containing inflation. And so right now, I think it's up to the board to make that decision. I think we're constantly trying to weigh the decision around, do we hold all of our capital right now prior to what everybody kind of thinks is going to be a recessionary period coming up? I think there's a possibility that right now we would really like to just kind of wait and see a little bit what's going to happen. I can't put words in the board's mouth. We have not announced a dividend. We do not have an active buyback program right now. We can discuss that around the board table and then go to the Federal Reserve with that plan. But currently, we do not have a buyback program. I think that may be viewed the same way in terms of holding on to the capital while we could be facing down a recession. Just from a risk management standpoint, that might be the best policy at the moment. But it's definitely something that we always keep on our radar and try to, make good decisions on all of those items as they play out. There's another question here about the treasury management tools to compete with regional banks and targeting businesses 50 million revenue and less. FIS currently has a online banking module that's called Digital One, and that platform does have the treasury management tools. We have remote deposit capabilities. We have, obviously, within the business online banking, they can, run ACH, they can move money around, they can do some things like that. We are looking at the possibility of moving to another system, but that is still in the process of being evaluated. So to the extent that those tools need modernization, we may make a change there. If we did, then that would be a system that is not an FIS particular system that would then be interfaced back to our core. So that is currently in the evaluation phase.
There's one question in here regarding M&A. We're always looking out for opportunities to increase shareholder value. And without getting too direct on that, if it makes sense, we're going to always look at it on the acquisition side or any other side. We're smart. Our motto is we know what matters, and we try to live it each and every day for each of you and our shareholders. So thank you. I appreciate the opportunity. Thanks for joining us. If you have any questions, please reach out, and we'll be happy to go one-on-one with you at a later date. Thank you, and have a wonderful day.